Hi, everyone. This is Tim Melvin of the Tim Melvin Deep Value Report and Banking on Profit newsletter. And we're back down here in sunny Florida. A nice wave of 80-degree weather, and we needed it after being in 8 inches of snow and record low temperatures in Baltimore a week ago. Really nice to be back down here. Got my Orioles spring training shirt on. Just watched them lose a game to the Pirates here this afternoon, but it's spring training, doesn't count yet. Going over with my little mobile office tomorrow to Clearwater to watch them play the Phillies and meet up with an old friend of mine from back in the when I first started doing all this craziness, selling variable insurance products and mutual funds with John Hancock Financial Services back in the early 1980s up in the Baltimore area. Anyway, kind of a crazy week for the markets. We were all over the place. We're scared to death that the Fed's going to raise interest rates. And I got to tell you that if your biggest fear is that we're going to get a quarter of a point increase in interest rates, your economy and your market are not really as healthy as you might think that they are. Anyway, for the week, the S&P was down 0.81%. The all-world URTH ETF was down 0.86%. And our leader this week was the small bank index, the QABA ETF, which was up a rousing 2.06%, and we benefited from that a whole bunch, but we'll talk about that a little bit later in this video. My friend Doug Cass, fellow Real Money contributor today, added his voice to the growing list of folks like Sam Zell, like Seth Klarman of Ballpost, who have warned us that the economy is not keeping up with the stock market. We've had this wonderful 6-year stock rally now since the bottom in 2009. Prices have soared by more than 3 times the low price back then. But, the economy hasn't really kept up with that. And I've kind of said all along that we have a disconnect. It's low interest rates, money being forced into the stock market, and more and more, the support that's coming from the massive stock buybacks, many of which have been funded with low-cost borrowed money. That's not really a recipe for continued success at this point. And when I look at the economy, I just don't see the growth that's there. People are talking about the U.S. as the best house in the world. The fact that our house is just crumbling while others are burning does not necessarily make it a wonderful economy to put a bunch of new money to work in. Just in this last week, we had weak retail sales. You can blame it on the weather if you want, but the fact of the matter is people just were not spending a lot of cash over the last few weeks. And we've had several disappointing retail sales reports in a row. Consumer sentiment was down. I don't think people are real happy with what they're seeing in the economy. If you make your living in financial services, maybe you're doing okay because the markets are higher and interest rates are lower. And that's kind of a nirvana in some instances for the financial services folks. But, not everybody can peddle stocks and bonds or put deals together. Some folks just have regular real jobs and careers, and they are not benefiting from the benefits of quantitative easing, in my opinion. So I know that everybody talked about the jobs report, and it was a good number. It was, a good number is better than a bad number, I'll give you that. But there's still no wage growth. You're just not seeing any wage growth. The jobs that are being created are not great long-term, high-paying jobs. The fact that we've been able to create a lot more cashiers, clerks, warehouse workers, bartenders, and service level employees at the lower end of the scale does not necessarily mean that we have this wonderful, great economy. And you definitely have a disconnect. Now, look, we've all benefited from it. We're investors. Our stocks have done tremendously well over the 6 years. So mind you, I'm not complaining. But I am saying that this type of continued disconnect, folks just aren't going to be happy with it. And it could make for incredibly interesting presidential election cycle, which the news junkie in me is going to love. But that's going to push the market all over the place if we do, in fact, get that kind of noise as the election year gets a little bit closer. And eventually, Main Street and Wall Street have to meet up. Now, there's only 2 ways that can happen. Either the U.S. economy gets real strong, real fast, or stock prices have to come down to reflect the underlying economic reality. When does that happen? I have absolutely no idea. I won't predict any kind of timing. One of those 2 things has to happen before too terribly much more time does, in fact, go by. When looking at the market, as a matter of fact, I saw that earnings estimates were actually lowered. We came in with a real positive vibe on earnings into 2015. Now they're saying, hey, we're going to, 1.7%. That's going to be our year-over-year earnings growth. That's horrible. Doesn't match up with what anybody had to say earlier this year. Here's the bad part. That's all backloaded. That's very much dependent on oil prices firming and the dollar not appreciating quite as quickly, because that's really hurting earnings for a lot of U.S. companies, particularly those, of course, that are depending on exports. So you've got some headwinds for the U.S. economy and for corporate earnings, and that could very well create some very stiff headwinds for the market itself. Now, all that's above my pay grade. I don't really trade based on macro events. I do like to talk about them. I am definitely a news junkie, and I follow it all. I try not to let it impact my day-to-day investment decisions, and so far we've been pretty good about that. We have a lot of cash in the main portfolios. That's not due to any macro call on my part. It's just due to the fact we can't find enough cheap stocks to buy. So a strict philosophy of adhering to the value principles, I think, is keeping us away from a potentially very troubling situation in the second half of 2015 and maybe 2016. Main Street and Wall Street eventually have to come together. I don't think it makes a lot of sense to be a really aggressive buyer of common stocks at this point in time. Now, there's always an exception to that. We'll get to that. But right now, our screens and searches just are not turning up a lot of stuff that we do not already own. We're seeing horrible earnings reports almost across the board in some of the cheaper stocks, not holding up as well in the safety measures as we might like. So we're content. We're picking away. We find some little things to buy, but we're content to sit here with over 50% in cash in the main deep value portfolio. Really helps me sleep pretty well at night. And, I've been through this before. I was a broker for a very long time, and it was amazing how dumb I got as the 90s progressed. And, from 1997 to 2000, I was probably the dumbest guy in the room at any given point in time. I owned no tech stocks, no Cisco, none of them. They never were in my portfolio. I lost some clients over that, but as John Marie Evelard said, I'd rather lose half my clients than half my clients' money. So by 2002, 2003, I was getting pretty smart again. And by 2004, 2005, I was pretty much, a genius, because we were buying when everything, broke out the Hetty Green card. We were buying when everything fell apart, and we just had some tremendous returns coming off those bottoms, buying distressed tech bonds and tech stocks trading for less than cash. It was incredible how many bargains were around. Will this cycle play out? Yeah, it will. It will absolutely repeat itself at some point in the future. I do not know when. And until then, we just have to be very, very patient. Now, patience pays. It always has. It will again. We'll keep looking, but we're not going to be aggressive buyers. I can tell you that until we get a significant inventory creation event. It's out there somewhere. I couldn't tell you where. The conditions are right for it, but it needs a trigger. And so far, I don't see that. Although maybe the rousing game that's going on this weekend of Where's Vlad playing out in Russia could be a trigger. Don't know if you've been following this, but Vladimir Putin has not made an appearance anywhere in about 9 days now. And social media, particularly Twitter, is just blowing up with possible outcomes in Russia. And it's been a lot of fun to read. Better than anything that was on TV this weekend, except for baseball and basketball, of course. But it's been interesting. If there's a big upheaval in Russia, that may be a trigger, particularly for the European markets. Now, there is always something to do, as Peter Cundall once said, and as you saw by that 2.06% in the QABA ETF, community banks is the place to be right now. Now, since the last video I shot, not only have I gone up and frozen myself and been in the snow in Baltimore, I've also had yet another bank takeover. So we had a bank in the Alliance Bancorp in Pennsylvania, was taken out week before last at a very healthy premium to what we paid for it. We cashed in for about a 55% gain. That now gives us 8 takeovers in the community, the banking on profits portfolio, and the average gain is in fact getting very close to 50% of the stocks that have been taken over so far since we started the portfolio in the middle of 2013. We also had on the deal.com this week, 4 of our banks were identified as potential takeover candidates because they're mutual conversions coming up on their 3-year anniversary when there can, in fact, finally be a change in control under the current regulations. All four stocks got a nice bump higher. One of them got a really nice bump higher and ran up higher on the week by about 20%. Right now, community banks are the place to be. That part of our portfolio is pretty close to fully invested. It's to the point now where we have to start to go through the portfolio because we've got more stocks we want to put in and not enough cash to buy them. So we've got to start trimming back some of the winners and stocks that we don't like as much as some of the newer buy candidates. Unfortunately, money is finite. We can't just buy everything that we'd like to buy. There's that many interesting and attractive stocks in the sector right now. Our buy list went out yesterday. We had 29 stocks on the buy list. Average price to book value was below 80% once again. Lots of activists involved in these various stocks. This is a place you want to be. I think you want to be there for, the next 10 years. I've been actively involved in the sector most of my career, and only at market peaks like 1999 and 2006 and 2007 were we really running bank stock light without many banks in the portfolio, just simply because they'd gone up so much and the multiples were unreasonable. We're nowhere near that now. There's a huge opportunity in the community banks. We're making money in this space with very little day-to-day volatility. Some of these stocks don't trade most days. They can be a little hard to buy, but again, patience pays. So community banks, if you're not in the space, you need to be in the space. If you're going to be in the space, I think I can help. So sign up for Banking on Profits, and we can take this trip together over the next decade or so. So, okay, let's see. Just a couple statistics on the portfolio that we put together last week. We picked 62 stocks so far since July of 2013. 58 of the 62 stocks are winners. That's remarkable. And our largest loser, guys, is 16%. The other three are that's a stock we still hold and they're still buying, obviously. The other three are single-digit losses only. In the interim, we have closed out 4 stocks so far, and the average gain on our 4 closed out positions, either by takeover offer or one that just ran up well over the current takeover multiple, so we went ahead and sold it, is over 53%. So the money's there. The stocks are there. They're cheap. They're safe. It's a wonderful opportunity. You really need to be involved in it. And I will get off my soapbox on the community banks for this week. Anyway, look, it's a great time down here in Florida. Hopefully you guys are starting to warm up around the United States. We got a nice string of 80-degree days going. Spring training baseball is on. The Orioles pitchers look great. I think we left the bats in Baltimore. Hopefully that changes starting tomorrow. So we've got a lot of power on that team, and that's kind of our plan for winning the American League East again. There's some exciting changes going on in baseball and spring training. The kid from Chicago was rested yesterday for shoulder fatigue. Came in and hit 2 pinch hit home runs. Kid looks like he's going to be a superstar. Some great things going on at the Chicago White Sox, the Miami Marlins, teams that have not necessarily been competitive the last few years. The Washington Nationals, again, come into the year looking like a super loaded ball club. So spring training's a lot of fun. I'm going to try to get to a few games over the next couple of weeks. It's going to be tough. Got a trip next week. It'll be a working trip, but we're still going to head down to the Keys for a little bit. And of course, I had to go to my daughter's wedding. There was no getting out of that. So my spring training baseball time is a little compressed this year, but I'll try to get to a couple of games. And of course, we have March Madness, and that's going to start today with Selection Sunday, and we'll find out who's playing who. And this is the only time of year that I'm a big basketball fan. I think tournament time with the one and done pressure is just an absolutely fascinating experiment in college sports. It's one of my favorite things to watch. So I'll watch that over the next couple of weeks. And really, all I want to see here is a Kentucky-Gonzaga final. I think that would be just a spectacular finish to the college basketball season and a lot of fun to watch. So anyway, main portfolio, a lot of cash sitting on the sidelines. That's our approach. There's nothing safe and cheap, so we're not going to force our hand. However, we're real busy and real happy with the extraordinary opportunities we're finding in community banks. That's keeping us busy. It's making us money, and we're not participating in a lot of the day-to-day macro volatility of the stock market, and that's how we like to do things. Anyway, this is Tim Melvin coming to you from down here in a very warm and sunny Central Florida. I hope you guys all have a great week, and I'll talk to you next week.